Hi everyone, thank you for joining this session, Expanding Financial Inclusion. I'd like to introduce Michael Fernandez, a partner at Leapfrog Investments, to introduce the rest of the panel. So round of applause for Michael. Thank you.
Thank you, thank you. And can I ask the rest of the panel to keep our introductions as brief and as tight as that, so we have more time for the question and answers. Quick introduction to myself first. Partner at Leapfrog Investments, recently moved to Singapore. So in this panel, I had the least commute time, the most time to actually come for the agenda for the meeting. And Leapfrog Investments, for those who don't know, is a profit with purpose investment fund. Raised in 2008 and with a strong focus on Asia and Africa, and within Asia and Africa in the space of microinsurance in our first fund. And we're beginning to look at how do we move forward from that. But we have a number of investments in the microinsurance space, in companies focusing on HIV or on mass market insurance in India and Nigeria, Kenya, Tanzania, Uganda, South Africa. We have with us, actually, we've unfortunately lost one of our promised members. He came down with, we believe, an attack of malaria. We're not certain whether that was in Indonesia or in Singapore. The Singapore authorities have claimed there is no malaria in Singapore, so this probably was Indonesia. We will evaluate that separately, and there's a Department of Health meeting which is happening separately on this topic. But on the financial inclusion topic, we have with us Happy Tan, Christopher, better known as Happy, with the Grameen Foundation, and he will introduce himself. We have Jeff with Unitas, and we have Ross with Village Capital. The way we're going to run this session, each of them will individually introduce themselves, talk a bit about what they are doing in the space of financial inclusion, hopefully use that time to also define what they see as the space of financial inclusion, what's included, what's not. Because that does remain, it actually has different definitions and different purposes depending on where you come from. And I think it's important for us to have some common alignment on what it is we're going to be talking about, and use each of them should talk about that a bit, and a bit about the challenges which they're facing in that space. After that, we'll go into a bit of a prepared question answers, and then really, hopefully, spend a large part of the time getting in an interactive discussion with the audience. So without much more, I will hand it over to Ross.
All right.
Well, these slides come first, so you come first.
Okay. It's alphabetical. It's like first grade all over again.
It's not. It's you first, Ross. That's all. Yeah, I know the basis.
My name is Ross Baird. I run an organization called Village Capital. I will talk about what we do in a second, but if we can advance the slides, I thought it would be better to start with the kind of companies we work with. The way that we think about financial inclusion is a bit broader than just extending bank accounts to the poor. I think that a huge percentage of our companies, we work with early stage for-profit companies that are also driving social impact around the world, and a huge percentage of our companies actively are trying to make basic goods and services affordable to low-income populations. And for us, that's financial inclusion. Whether you have a hardware technology, whether you have a software platform, whether you have an information or educational outreach component, making goods and services good, quality, and affordable is financial inclusion the way we define it. So let me talk through a few of the companies that we've been lucky enough to work with just to make this as tangible as possible. Top left is a company called Kitabu that we work with in Nairobi, East Africa. If you look at the budgets of families living in the slums of Nairobi, one of the biggest household expenses is textbooks. Huge hunger for education among upwardly mobile, poor Kenyan families. Textbooks are typically 20 to 30 years old and incredibly expensive. Kitabu has built basically an e-reader where, and this is the vision of the product, it's incredibly early stage, but the vision is you would be able to afford this e-reader for $10. It would be subsidized by a telecom carrier, like your mobile phone is subsidized by telecom companies. And you could basically rent textbooks by the day, by the week, and it would cut the cost of textbooks for low-income families 90%. Now, just to tell you about the stage of companies we're working at, they have a hardware. It currently costs $40, not $10, but they're working to bring the price down. They have some sort of progress made with the telecom companies. They have less progress made with the textbook company, but that's something we're working on helping with. But so it's just a long way to go before we could declare victory, but the vision of affordable textbooks for Kenyan families is financial inclusion. Just to mention a couple of the other companies up here that are in Asia, Simpa Networks is in India, and Simpa makes a mobile meter that you plug into home solar energy devices where typically, I mean, this has been around for probably 15 years, companies like Selco selling solar energy systems to homes, but typically they've been out of the reach of low-income families. Simpa enables you to pay by the minute for energy with your cell phone. Sanchayan is another company. They're in Uttar Pradesh and expanding to Bihar in northern India. They have kiosks set up that are almost like H&R Block, like cheap places where you can stop in and buy ID cards, buy micro insurance, buy, set up a bank account, and they're value-added resellers of products that companies, maybe companies that these guys are invested in are producing, but it's much more information access, reselling products that are already out there. So we can talk more about details, but I thought it would be great to start just some of the innovations that are going on out there in the world. Go to the next slide. One of the things that people, I think, misunderstand about financial inclusion is I think the things that are really going to make a difference, and if you look at the things that have made a difference, it's mobile payment platforms in Kenya, it's microfinance in India, which Chester has been involved with from the beginning, and he'll talk a little bit more. These are things that everyone declares a success, and whether or not they're a success, they have been able to reach millions of people around the world. But for every for every SKS microfinance, there are 20 other ideas like Kitabu and like Sanchayan that we hope they don't fail, but they might. And I think that the things that really are disruptive in financial inclusion are either going to reach 100 million people plus or flop. And it's very rare to find a, quote, safe financial inclusion investment. So the way that we think about it, and these guys have different approaches, but the way that we think about it is we are placing a very high number of small equity investments in companies, any one of which could be very successful, but we have a high degree of risk tolerance and know that most of the companies that I described to you will fail. And so I think that the biggest problem in financial inclusion is people think financial inclusion and they want a 3 to 5% concessionary interest loan, and I think it's much more a very large success or a high volume of failures. And so I just want to, I want to, if we can reorient risk tolerance towards financial inclusion, that's one of the things we think about a lot. The next slide. How we think about that specifically, and it's different than the rest of the panel, but so I'm not saying this is the right way, but this is the way that we think about it, is just working with a high volume of companies. So what we do at Village Capital, we have a nonprofit that operates incubation, acceleration, use your favorite buzzword, but essentially business development assistance programs for ventures like the 3 that I described to you all around the world. We've run 18 of these programs. We have over 300 alumni. The Blue Stars are where we've operated or launched programs. The Red Stars are where we currently have interns like Risky in Jakarta who are trying to find the next generation of companies that we showed up there on the screen. We'll typically have 15 companies per program. We'll invest in 2 of those 15. We have, next to our nonprofit, we have a fund that makes investments in companies that are picked by their peers. So we have a bit of an unusual investment thesis, but it's all entrepreneur selected. And the idea, the name Village Capital came from the village banking methodology and microfinance, which these guys might talk a bit more about. But essentially, keeping the cost of deploying capital very low and doing a high volume of investments over time builds a case to where we can maybe find that 1 in 20 ventures that are incredibly disruptive. So these are some of the numbers of what we've achieved. I will probably stop talking and just give you a snapshot of what we've done, but we are incredibly excited about these potentially disruptive ventures, knowing that one by one they're very high risk, but in the aggregate there's quite a bit going on that you can be really, really excited about.
Thank you. Hi, I'm Jeff Woolley. I think I should get out of the way first of all. Most people know me as Chester in the environmental, so when you hear the interchangeable nerds, we can tell the story of that later, but it's, the number one question is why do they call me Chester, but that's a secret at this point.
Sorry for tipping your hand.
I know, everybody has it, so let's go on. I think that as Unitas Impact, as we actually look at things, we actually are focused on poverty as an overall basis. And I think that if you look at the list here, we use this slide essentially as our philosophy, where if you look at the different reasons for poverty, the precarious incomes, limited access to capital, affordable housing, limited education, et cetera, going down, we actually divide them into two categories, right or wrong. One is for business that are actually going to be solved by the business sector. And we actually think that the lower ones are probably better matched towards NGOs, government sectors, et cetera. So we actually concentrated on the top three because we come from commercial backgrounds. I'm a venture capitalist by background, started 2 or 3 venture firms over the years in both Europe, et cetera. And candidly, I couldn't figure out anything else to do because I have only the skill of being a venture guy. So that goes to that. Next slide here. Unitas is basically, as an overall organization, confusing because we have lots of different entities. We do have a nonprofit that's the original going back to 2000. We have an equity fund, which was well known in 2004. It was the first equity fund in microfinance. It's one of the most successful, I suspect, and it's now run by Elevar, which was basically Elevar is one of our offshoots from us. We also have Unitas Capital, which many folks will know. It's our investment bank. The reason we actually formed that is to actually help guide capital. They've raised at this point about $1 billion for social ventures, mostly based in India. Unitas Seed Fund, which is actually very similar in some ways to Village Capital, doing $100,000, $200,000 investments in very young companies to get them going. And then Unitas Impact, which I'll talk about simply because I'm the CEO, right? And at one time, I seem to actually just go through one company to another. They kind of kick me out, and I have to go find something new to do. So in Unitas Impact, we actually focus on livelihoods. Next slide. Livelihoods to us, and really in the financial inclusion investments, is that can you basically look and say, what are the supply and distribution chains to particularly, and how do they affect the poor? And if you actually think about it sometimes and say, somebody that's a working poor person is most likely involved in a supply chain or a distribution chain that essentially is inherently unfair to them. Almost in all cases on the supply chain, many of the people doing the most work will only get 1 or 2% of the retail value. One of the easiest ways to do that is to relook at the supply chain, try to apply technologies and other solutions and kind of recreate companies that would actually disrupt those supply chains. These are actually generally massive companies that can do this because you're going to take on massive industries. Examples are here. One is Ruma, which maybe I should let Happy, because Happy is on the board of Ruma. It's out of Indonesia. But it's a very simple idea from a distribution perspective. We happen to like mom and pop stores, and we have always been fascinated by them across the board. If you can basically say, we are making a bet at Unitas that mom and pop stores will continue to be the center of commerce in the rural and semi-rural areas for the next 30 years. So if you can empower the trust points that these people know by providing them products, electronic products, regular products distribution, you can essentially build a platform of 100,000, 200,000 of these stores in which the stores themselves, which are the working poor, actually start to make more income, but even just as important, that their consumers actually get the best product at a low price and respectable service. And I think if you're, one mantra over the years that I've been working in poverty is that the poor, and I'll say this again, are generally always looking for a good product at a fair price and respectable service. And that last one, I think, is really important because the poor get treated poorly no matter what they're doing. And I think it's important to find organizations that respect them as people and to do that. Microbenefits, as I'll just go quickly through, another portfolio company. It actually provides benefits to the frontline factory workers of China. The company's become very successful. They now have Apple, Amazon, Continental Tire, et cetera, et cetera, et cetera, as a list. The idea here is actually quite exciting as a basis. It's all done through electronic means. They come in, if you sign up with them, they provide a welcome package. The worker gets a little card that says he's a VIP. If you're in China, most of those people know you have to be a VIP to be anybody. So you get a VIP card, you sign on to a social network, you download a Yelp application right away, an application that then actually shows where discounts are around them in the factory, and that's their first benefit. And from there, we can actually then have training modules. We have educational modules that are all downloads in game forms onto the basis, and we have insurance modules, et cetera, and then the big multinationals pay $1 per employee for every application. It's a menu-driven basis. The company, once again, is in a critical stage, but right now we have close to 1.5 million workers through that, and the company is actually expanding quite rapidly at this point. Canara is an Indian-based company. Once again, we've always been trying to crack the SME space. SME is difficult. I think a lot of people always ask to me why microfinance seems to work and SME doesn't. It's a mere fact in my viewpoint. Microfinance is methodology. SME lending is credit. And when you check someone's credit, it takes money, time, and effort, and so you can easily give somebody a $500 loan, but could you spend $100 giving them the $500 loan, which would make it an unreasonably expensive loan? So we're always looking for ways. Canara is a very inventive way who actually looks at supply chains and distribution chains and tries to pick out already existing entrepreneurs that need $2,000, $5,000, $10,000, and we actually know where their revenues come from, so you actually can check them a little bit less. So overall, that gives you a little bit of a feel, and I should actually probably say Unitas is actually historically well known for microfinance. We have 26 microfinance banks that are our partners. In India, we have 17. SKS is one of them, and yes, I do sit on the board of SKS, and I was the founding investor. But so you can take pot shots on that on a later time. So.
Good afternoon. So I'd like to talk about some of the transitions happening within Grameen Foundation, because I think in many ways it parallels some of the challenges we're seeing in terms of microfinance and the limits of its success. So first slide. But we're, prior to this change in last change of strategy for us, one of our leading instruments or tools was the growth guarantee fund that our capital markets team was promoting. And the idea there was to try to get the local capital markets to invest in microfinance institutions, see them as an actual asset class. And the way to encourage them to do that was to say that, okay, we'll guarantee 50% of the loan that this microfinance institution is borrowing from Citibank in Manila, for example. And so that was a good success, but what we're seeing is that the more we succeed with that, the more we see that microfinance institutions are clumping in these easier to serve areas. And because of that, there are two somewhat unintended consequences. Number one is that you tend to have very heated competition in high density population areas. So there, for example, there is this neighborhood in the Philippines, in Quezon City, where there are about 20 formal MFIs and about 10 other financing companies fighting for about 80,000 households. And so that would potentially lead to multiple borrowing and would potentially lead to over-indebtedness, and which is what we saw in southern India, for example. So when you have these issues of a lot of supply available for credit for microfinance institutions, but you don't really deal with the underlying issue around the tendency of microfinance institutions to go towards high-density populations, then you'll have those kinds of issues. And why is there that tendency? Well, primarily because the secret sauce of microfinance, which is, well, there are several, but you know, one particular one would be small amounts, frequent collections, right? Which means it's a very high-touch business, which means they gravitate towards those areas where you will have easier to serve communities, which are higher density communities. If you need to travel from one center meeting to another and spend half a day doing it, you will never break even the way many microfinance institutions expect to break even now. So that's why you will see in many countries right now, in many mature markets, all of these MFIs battling in these urban, peri-urban communities. And the other unintended consequence there is that the rural, remote communities suffer continuously from this chronic underinvestment. And then that's the macro level issue there. But then there's the micro level issue, again, of these low population density areas, which is the secret recipe of small amounts, frequent collections. They generally work with poor households, but when you look at agricultural poor households, there's a slight nuance there. In many cases, they will need a lot of input, supplies, and therefore $100 loans don't work very well for them. And then worse, from the time that they planted until harvest, there's really no cash flow, at least from that main source of activity. And so the small amounts frequent collection recipe or formula doesn't work very well in that context. And so that's what we're seeing in microfinance in terms of this plateau of financial inclusion. How can we expand more financial inclusion within the successful context of microfinance? Well, we need to address this problem of the low population density in rural communities. And just to give an example of that, you will see in this next slide, here you are seeing the track record of loans from 1996 to 2006 in the Philippines on the, okay, left, your right. And then on, on your left is the poverty incidence map of the Philippines in 2006. And what you'll see is it's almost a reverse image. In those areas where you have the highest poverty incidence, there is very little microfinance activity. On the flip side, where you have a lot of microfinance activity, you have low poverty incidence. Now, our friends in microfinance would say, oh, well, then that's actual proof, called DUFLO. and say that there's actual proof that, you know, where microfinance is, there is low poverty and it works. And he said, yeah, that's nice, but that's not exactly how we interpret it. But how we interpret it is that the lack of density in population that makes it hard to sustain any kind of economic activity in those remote rural areas also make it hard for microfinance institutions to have sustainable operations there. And these are institutions that are committed to poverty alleviation. So it's an important reality check for us. And so the question, it's not a question of lack of capital. It's not a question of lack of commitment. It's a question of you need a new business model, the one that works with low density populations. And so last slide, and this is getting to what we want to focus on in the coming years as Grameen Foundation, is to really figure out what this new business model would look like. And to be very blunt, we don't fully know what all of the different dimensions of this business model. But two dimensions that we want to make a bet on would be to use the mobile platform to reduce transactions costs for financial institutions that want to serve remote communities. We know very well, though, that the phone is not going to be a replacement for the loan officer. It's still a relationship business. But there must be a way to use the phone creatively such that the frequency of meetings between the loan officer and the borrowers can be significantly reduced. And the caseload of the loan officer, which right now, say, in Indonesia and the Philippines would be something about 300, 350 borrowers per loan officer, can be significantly increased. So how can you use the cell phone to be able to do that? And one key piece of that, as Jeff was saying, is to create this network of agents. The warungs in Indonesia, the sari-sari stores in the Philippines. Many times these are borrowers of the microfinance institutions. Why can't you deputize them to be able to collect the money and then to disburse the loans? Because that will allow the borrowers to go to them very quickly and then they don't need to travel that much in order to get their loans. And then through the mobile phone, you'll be able to get real-time information and to get those kinds of cash flows quickly, done quickly and safely. And number two, we think that a key piece here is to connect the farmers to agricultural value chains that can significantly enhance their business prospects. Now, we're not inventing value chains. It's been there before. What we can do is to provide some of the mobile platforms to get information flowing through these value chains. But the key point here is this. When you have working agricultural value chains, usually there'll be a good private sector buyer at the end of it. And the key thing there is that that will help the farmers, smallholder, subsistence farmers, start thinking of themselves as business people rather than just subsistence farmers, which is the same kind of mentality that really created the success for microfinance institutions. It wasn't so much the capital. It was the shift in perception of themselves, of the women, that I'm not just a housewife that is trying to make things meet and make sure that my children don't starve. I am a businesswoman. And I think that kind of mental shift is really just as powerful as the capital we're providing them. And so the value chains are important. Those are the ones that will deal with some of these distribution issues. But it's the mentality shift from having a private sector buyer at the end that really is critical in connecting to the value chain, and so in making it work. I'll stop there. Sorry for that.
Thank you all. I think this was a fascinating introduction to the breadth of financial inclusion, I think. And we did hear, as going down the different presentations, in my mind, a few things which struck, and I'd want to get back to some of the panelists and ask them to follow up a bit more. But what is financial inclusion? And there are two institutions here which talked a lot more about microcredit, and one which was talking a lot more about enabling equity, which helps consumers get access to different services and products in different ways. Both of them coming under the same banner. Is there more to financial inclusion than that? Is that really the remit? How do one draw the line? What would be considered valuable financial inclusion and the purpose of financial inclusion? There was, I saw on the Unitas discussion, Jeff, and even Ross was beginning to talk about, to some extent, the role of where, actually Ross more than that, the role of government, the role of philanthropy, grants vis-a-vis the role of investment capital, and where those lines get drawn and how those lines get drawn. And there's an unsaid story, which I know Jeff was talking about, where those two lines intersect, the effect it can have in financial inclusion. And maybe we should, not necessarily into specifics there, but talk about the challenges when investment capital and philanthropic capital, which are running at different rates, when they overlap and they're providing the same service, the potential disruptive effects that could have in the system, as well as where there could be constructive effects in the system that could play the appropriate roles in the marketplace. And I'd love to chat a bit more about that. And then also talking a bit more on the role of technology and how else technology can be used in a disruptive sense in enabling microfinance. But maybe starting off with Ross, if you could talk a bit more, I think just on how do you see the broad space of financial inclusion, the role of microcredit within that, but what are all the other levers which could be considered as one thinks about financial inclusion as we as a group think about advancing financial inclusion and the purpose of advancing financial inclusion?
Sure. Well, I think just if we're talking basic brass tacks here, the Millennium Development Goals of the UN in 2000 said by 2015 we are going to increase the number of people not living in poverty, decrease the number of people living in poverty by a percentage that I don't remember, but we can agree that the UN wants less poverty versus more, right? There's one thing that I have seen enable people getting out of poverty more than anything the UN talked about. It wasn't mentioned once in the 30-page Millennium Development Goals manifesto, and all of you probably have one on you. Someone reaching your pocket, grab what's in it, not your wallet. Yes, yes, great. Wave it high for everyone.
We're going to sell that later on.
Yeah, oh, that's great. So to say that, I think to say that this particular innovation, quote, solves poverty is not realistic. I mean, I think that microfinance has done a tremendous amount in providing access to credit to people, but it's also done a tremendous amount, I think this is an underrated benefit of microfinance, it's also done a tremendous amount in giving people much more predictable income. So for families that have a lot of money in harvest season and no money when it's not harvest season, being able to take out loans when cash flows are low and repay them when cash flows are high, people might say, and if you look at a family that doesn't make any more money necessarily because of taking on a microloan, but has a predictable cash flow every month, that is actually, even if you're not making more money, that's better than the steady state. Having a mobile phone where you can get better information about where to sell your crops and at what price so you increase your income, that is better than what you have now. So I guess what I would say generally how we think about financial inclusion is it's information plus access to quality goods and services that are cheap. And if you have good information, either your income goes up or the price at which you are buying something goes down. If you have access to quality goods and services that are cheap, whether it be through credit that enables you to have cash in February when you typically don't have cash in February, or whether it's all of a sudden I can afford this home solar energy system because there is this finance mechanism that allows me to pay it down over time, that's better than the default state. So maybe I might take a bit broader definition of financial inclusion than these folks do, but for us it's information plus access that in the end increases the amount of money in your pocket. And that's brass tacks what I would say.
Yeah, I don't actually think that I think we all agree that financial inclusion should be done. I always like to use the example that, I mean, if you were an Indonesian fisherman 300 years ago, you would have probably brought your fish back and either used it for your family or sold it in your village. And pretty soon some smart guy came and said, hey, I live about 4 villages over. If you give me one of your fish, I can go over there and sell it, and I'll take 25% of it. You get to keep 75%. And he said, sure, he can actually catch more fish. And then all of a sudden, some guy says, hey, if you go to the next island, I live in the next island, I only take 50% of the cut, and then to that. And today, most of the fishermen get about 2% of the actual product. And if you look at the reason I bring it up that way is that electronic and particularly information, payments, et cetera, have all of a sudden said that distant island, that distant continent is now coming closer and closer back to the fishermen. And to me, that is a good illustration on how technology has brought something that was very mysterious, a black box. You need me because I'm going to charge you a lot of money to bring that product. And now it's actually coming further and further back. I think on your question about government, or not government, just grants.
Philanthropy versus investment.
Philanthropy. I think philanthropy and investment work very well together. I think the one thing that you have to be as a good philanthropist is actually understand that, first of all, in most cases, I think most philanthropists don't want to disrupt the business chain, because the business chain, for better or worse, is probably the most efficient to cover scalability. Right. And so, there's a lot of examples that I can think of that you actually work very hard on something. I actually just remember an example where some great entrepreneurs in Cambodia were working on some great toilet solutions, kind of got their business going, and all of a sudden a good-hearted NGO came in and started giving away free toilets, which essentially bankrupted them. Which, once again, neither person wanted to basically say that they were doing bad. But I think it's very important not to do things that undercut the basis of the business itself. Mm-hmm. And I think that grants, by the way, very well done is that, I think the other thing that I've learned through this is that a lot of people have gone around for a long time, and I understand to raise money to say, and particularly debt, to say this is not actually risky debt. I'll pay you 2 or 3%, that's what you're foregoing, et cetera. As much as I'd like to say it, and as much as I've been in microfinance for years, we're doing some of the most risky stuff in the world. And that basically says that every once in a while we'll win, and a lot of times we'll lose. So you got to make a lot of money on the time you win, because the time you lose is pretty common at this point. And I think that we need to remember that. And sometimes if you can use grants to mitigate that risk, and to say, yes, somebody should do a first loss fund, somebody should do this. Those, I think, are some of the best ways to help entrepreneurs, because it's not just about the entrepreneurs making more money. It's saying they can't get investors because they don't want that much risk. But eventually, if you can prove a little bit, and I'll give you just one example on how I actually see grants helping quite a bit. If you basically, on mobile technologies, actually can use a grant to get the actual infrastructure up sometimes, and then essentially that either can be paid back or basically subsidized initially, the ongoing expenses can actually be very good for a business going forward. So I think that those are very harmonistic perspectives, but I do think it's important that the two work hand in hand and don't try to undercut one versus the other.
I'll start with the definition of financial inclusion. I think what you want to be able to do is to create an environment where you are providing everybody, particularly the poor households, with access to the products, tools, and information that will allow them to take greater control over their financial lives. And so, as Ross said, part of that is making sure that people have access to businesses that will or employment that will provide them stable, predictable income. But there's also the aspect of being able to absorb unexpected shocks, economic shocks. I mean, even in the United States, right? If you look at the vulnerable poor, the ones that are going to go below the poverty line, it's probably because of they got laid off, they had some medical emergency, or they had some divorce issues. And those kinds of, and unfortunately, particularly now with a lot of natural disasters, all of these issues disproportionately harm poor households. And then number three, you want to be able to have, not just to provide low-cost financial transactions for poor people, but you want to also be able to provide opportunities for asset building. Particularly, is there a path towards getting passive income, particularly when your productive years are going down? And then one last dimension about this is that it never happens in a vacuum, right? It's not like, poor people are just, they just don't have the income, but if you just give them the opportunity, things will get better. A lot of times there are bad habits that are already inbuilt. Right? There are already issues around predatory lending that they have to grapple with even before they have an opportunity to meet with the microfinance institutions. So in many ways, how do you stop the internal bleeding? And so in a way, your measurement for success is not so much from zero going up. It's really stop the hemorrhage, let it stabilize, and then slowly go up again. So that's kind of, now how can you come up with a program that provides a robust suite of products and services to be able to address all of those different aspects? I think that's the challenge of financial inclusion. Last thing about technology.
Yes.
In terms of what's disruptive about technology, particularly the mobile phone platform, is that it's two ways, right? It's no longer just experts providing information to the poor. It's really poor people being able to communicate their preferences to us. And that is a very democratizing type of power. And that's what makes the system unhinged in a good way. And a lot of times the information isn't even explicitly asked for. It's the usage data that you're generating through those kinds of transactions that you have right now, which is very, very powerful. And once the way how it can continue to work to improve our work is that once you have this usage data, then the temptation for us to become more and more paternalistic in the way we design programs, that goes down. Because instead of our notions of what the poor need driving our design decisions, it's now going to be data on what they actually use. And that's what makes it very powerful.
Yeah, I want to say something about that power dynamic, because that really drives a lot of how we think about this. So the key reason that we do investments the way we do at Village Capital, where it's peer selected rather than a judging or investor panel selected, is we want entrepreneurs to build ventures with the customers as their primary drivers rather than what the person who has the money thinks they should do the venture. I mean, there's a real shift in power dynamic that has the entrepreneurs focus on the customers rather than the people with the money. And I think that that is really telling about financial inclusion generally. So how many of you have ever had to raise money for your organization or your business and you really needed the money? I'd say most everybody in this room, me included. It's terrible. You have to be really nice to people that you might not really want to work with, but they could fund you. You have to figure out what people want, and you figure out how to judge your pitch for what they want to hear. Like, it's a real power imbalance, and it's terrible. And being poor is like that every day. And how many of you now have had to raise money for something where you didn't really need the money? Maybe you're in good shape and this is expansion capital, but it was nice to have. Sometimes. No. I mean, there have been times where people say, listen, I don't care if you're offering me this amount of money. Like, I don't need it that badly. You're a real jerk. I don't want to take your money. I say that to Chester every day. Chester's never actually offered me any money, but no. When all of a sudden when you have that optionality to choose to buy the service, or when you have better information about your product than the person selling it, all of a sudden you're in a position to decide whether this is the thing I want or the thing that I don't. And so there is a real power dynamic shift when people don't have to take the first and worst option just because they don't have any other choices.
Okay. I have been informed that we are running very short of time, as usual. So we will need to move, and what I'd want to do is open this up, because it's useful to begin getting, I think, a lot more interaction from the group. Get a set of questions, get 3, 4 of them, and have the panel give some chance to reply, and hopefully we can get a couple of those rounds done. But it's open to Q&A.
Singapore. I'd just like to ask 2 questions. One is, what is being done in the sector currently to ensure financial inclusion for the middle to poor strata group? And what else can be done to ensure that they don't fall into the poverty line?
Okay. There's no other questions? Well, one more.
Just, I'm curious, we're in a panel on financial inclusion, so you'd think we'd be talking about traditional microfinance. We're talking about everything except traditional microfinance. Why is that? Is it microfinance has worked so well we don't need to talk about it anymore, or not it, or has it not worked well so we've moved on to different things?
Yeah, I got a question for Chester. I liked what you were talking about on the Canara capital model, sort of NFI plus space. And to me, I would even extend my definition of financial inclusion to include SME financial inclusion as well. I'm seeing that sort of new models emerging in that space. So I guess if you were to put your crystal ball on how, looking ahead to 5, 10 years, what is the evolution of that space? Are we looking at a whole new asset class compared to microfinance, or is it just a bigger version of microfinance and that's something completely different beyond that? I'd like to hear your insights on that.
I'm Alan Gordon from Oxfam. We do a lot of work in rural areas with provide finance to smallholders along the value chain. We tend to use cooperatives as the intermediaries. Some of them have become very good at running on lending. I just wondered if you had a perspective on that as the intermediary. We also use them to link the smallholders with markets and provide them with better prices for influence and advice and extension and so on. So we're quite keen on the entrepreneurial cooperative, the rural intermediary. I'd like to get your perspective on that.
Okay.
I can take some of them to that. I would also, just to kind of answer a little bit of each question, and I'm not going to answer Bob's. I think that a lot of times when we went into microfinance, we tried to basically solve the hardest problems first. And I think that in your question is, oftentimes solutions should actually start, I think, at the lower middle class or upper lower class, rather than at the poorest of the poor, because if you can get the system going, you can work your way down. So I think that that's one of our biggest conclusions over the 13 years we've been in business, is to always try to do something that's doable. And people can say, you know, these people aren't really poor. I can guarantee you that most of these people are really poor to that basis. When it comes to the SME finance basis, I think that it's just a mere fact, and I think Happy did the great presentation. I always say that microfinance, SME lending, everything is about the cost of actually forming the loan. Microfinance is a methodology. It is not a credit. And if you think about it, it's actually done via everybody basically being, you know, 5 women in a group or whatever, village models, et cetera. That's the methodology. In SME lending, you have to do the credit. And historically, credit to do on people when there's not credit bureaus is expensive. So to me, to crack this issue, how do you basically either provide credit bureaus, provide some due diligence, where if you're going to make a $500 loan, you don't spend $150 doing the credit. That's the golden, you know, egg that somebody needs to solve, and I think that there is some change doing it. But historically, and I'll be the first to say, SME lending on an overall basis has been a disaster in a lot of characteristics. It's just, you know, people will say there's success. I will tell you, I know a lot more problems with it than that. And then on Oxfam, I think that, you know, the rural areas, to me, technology in the rural areas is really the key to helping them get back together. Because all of a sudden, you know, I always use the examples, you know, we now have partnerships with Amazon, and Amazon can essentially provide that small Kiana store owner or that small Sari owner in the rural area the same product at the same price that a citizen is, and actually provide credit to them. And that is so far away from what the average rural person is getting today. And you can take that example and turn it around 14 different ways and come up with great solutions for that period. So,
just quickly on the, so as we expand microcredit to microfinance, we're seeing a lot more insurance products creeping in and being able to address some of those issues of vulnerability for middle-income households. The problem, though, is most of the types of insurance we're seeing are those life insurance types, usually those associated with the loans. But when it comes to the really critical ones like health insurance and like crop insurance, people have yet to figure out, people are starting to develop the data sets to get the actuarial computations done, but to offer it in a cost-effective way, we're not there yet. So that's one of the issues. In terms of mainstream microfinance, in part because, we don't talk about it as much because I think that the model has been generally accepted. And I think with all of the hype that both the industry and non-industry has kind of connected to that, and how it was kind of deflated in the past few years. You know, despite that, we know that it is a solid product that is meeting a need. And so to that extent, we're kind of saying, okay, that's successful, but what we need to understand is how that success is limited. And let's not make the mistake we did before, which is to frame it as a silver bullet or the magic bullet, because there's no such thing. I mean, the problem right now is maybe the mobile phone will be treated the same way, largely because Gates Foundation said everybody should be using mobile phones. But 5 years from now, and then same thing with social enterprises. 5 years from now, we're going to be having the same conversation about why wasn't social enterprise and why weren't mobile phones that successful, right? So let's stop thinking that way and just, think of how we can combine these things to make them work better. In terms of cooperatives, it varies from market to market. I think our experience in Latin America, particularly the cooperatives that are connected with some of the fair trade activities, they are becoming much better intermediaries. But in experiences in Asia, the cooperatives are very weak. In the Philippines, there are a lot, whether it's the farmers' cooperatives or credit, they're very weak. Indonesia, it's also fairly weak. Many are co-opted, particularly in Indonesia, because of government connections. But I think one of the fundamental questions there is that the quality of management is often questionable because many of the managers are voted from membership. And unlike many microfinance NGOs where they actually bring a lot of expertise from outside. So it really then becomes a question of the quality of the pool to begin with. And that's where kind of the cooperative structure becomes vulnerable.
I'll be brief. I know we're running short on time. I'm going to synthesize these and make 2 points. One is, I think your question really gets at a question that you asked, which is how businesses interplay with philanthropy. I think that business, is about disruptive upsides that completely reshape markets, we hope, in an inclusive way. There's a whole flip side to that, which is the safety net, which is, it's not business's job or capability to provide a safety net for people. In the way that we're structured, we have, and this is a very narrow example, but we run a nonprofit that provides a basic threshold of business viability, customer validation, financials, capacity to and opportunity to scale for all of our businesses, and then invest in a subset that really do scale. But what the philanthropy does is get, we hope, all the ventures up to a baseline level where they then have the opportunity to grow. And I view that as a really good, it's the way that we structure it, but it's how I think philanthropy and business should play together, where government/philanthropy is baseline of opportunity, and then business can do really exciting things. I think maybe to your question and a couple of the other lines of thought I've heard here, I think that a lot of what people have been doing, and the thing that microfinance did that was really disruptive, is it said, listen, these basic old lending methodologies were developed by the Medici in Florence and the insurance houses in London for very different customers with very different balance sheets than the poor of the world. They developed a methodology that was completely different and is working very well for a very specific type of demographic. So in terms of SME lending, people are saying, I think, how do we take what was developed in London in the 17th century and apply it to a business that people in London had no experience with anything like? I think that some of the most interesting SME access to finance things that I'm seeing are like a company called Lindo in the Philippines that's developing your credit score based off of who your LinkedIn friends are. Or, we have all kinds of data that's a ticking time bomb because we have no idea how to use it well or poorly. But there are all kinds of new methodologies for these types of businesses that have been developed. I think that it's very dangerous to say, banking, loans, or microfinance solves all problems. We have a very specific type of loan that we haven't developed a good methodology for yet, I don't think.
Okay. Thank you all. I think just, wrapping up on this. First, be clear and careful who your LinkedIn friends are, because if that's going to be used for credit rating, I need to defriend a lot of people. I'm going to be doing a cleanup. There. 2, financial inclusion is not only microfinance, but microfinance is clearly a big part of it. It's not, but microfinance has worked to an extent. It doesn't solve all the problems. Asset management, building up safety nets, building up surpluses, helping consumers consume consumption goods in a better and more efficient fashion, all needs to be part of the broader financial inclusion umbrella. And sometimes some of these are ignored, sometimes some of these are sneered at, but they're all actually very important. The poor need to do all these things. They need to build their safety nets. They do need to consume. They're not just out there running businesses, right? And you need to have a range of products which offer all these services. Technology is clearly going to help. And I think the combination of microfinance with technology, savings with technology, safety nets and insurance with technology are going to help push this deeper. But again, it's unlikely any of them are going to be silver bullets. So it's going to require a lot more than that. It's going to require some very creative thinking about the business system, to disrupt the business system to make it happen. And to make that disruption happen, it's clear philanthropy has an important role to play to support some of the initial work in that process. But it's also clear that philanthropy should not overstep that. When the commercial business models exist, you need to allow those commercial business models to flourish. And there's a risk there that short-term grants and short-term philanthropy can prevent some of those commercial business models from taking off and scaling. So the lines need to be very carefully thought through, and the partnership and that continuum respected to make sure that some idea which has been created is actually allowed to flourish in a commercial fashion. Nothing much else, and I think we're broadly on time. Thank you very much, and thank you for staying awake in the post-lunch session.